China begins imposing tariffs on U.S. farm products today. The policies include a 15% tariff on chicken, wheat, and corn, as well as 10% on products like soybeans, pork, beef, and fruit. China is the #1 importer of U.S. soybean products, and soy exports are a major part of the U.S. economy. It's America's #1 agricultural export, adding $3.12 billion to the U.S. economy in 2023, according to the U.S. Soybean Export Council. So, how will these tariffs impact American businesses and consumers? Joining me now is Jim Sutter. He is the CEO of the U.S. Soybean Export Council. Jim, thank you so much for taking the time here with us. Just walk us through your thought process that you were kind of rolling out for the organization, for the team as well, as you're monitoring all of the tariff talk that's taking place.
Yeah, thank you very much, Brad. Appreciate the opportunity to talk with you. And it's certainly not what we would want to see happen. This is not our first choice. You know, we have been working in China for 43 years now. Our organization, U.S. Soy Farmers, working together with USDA's Foreign Agricultural Service, recognized early on, back in the 1980s, that China was going to grow to be a very important market. And wow, did it. You know, it has grown to be the biggest importer of soy in the world. And also the biggest, as you rightly said, is the #1 customer for U.S. soy exports. So we are hopeful that this will be a short-lived situation. You know, back in 2020, January 15th of 2020, the United States and China, with great fanfare, President Trump and President Xi and their administrations negotiated the Phase 1 agreement. And it contained a lot of really good things that were going to be done, both on a pure trade perspective, but also in terms of easing lots of regulatory restrictions. It started doing that, but then COVID hit. And then we changed administrations, and it sort of lost its focus. So what we would hope is that the situation we find ourselves in today, which isn't exactly what we want, but hopefully we will be able to quickly get back to a new and improved Phase 1 or a Phase 2 agreement, which includes many of those same things that were negotiated before, and allows the two countries to get back to a solid trading relationship.
Jim, after there is an agreement, how quickly do we see some of the action that takes place from purchasing?
Well, the last time an agreement was signed, back when I mentioned in 2020, it happened almost immediately. We saw Chinese companies start to purchase U.S. soybeans, and prices kind of rallied very, very quickly. This time, we've already seen the expectation of tariffs have had somewhat of a negative aspect on prices. I mean, prices are relatively low for U.S. soy because we had a record crop here in the U.S. last year. There's a very big crop growing in South America. We are sort of a global crop, so we depend upon the global supply and demand. So we have prices at attractive levels for consumers already. So we don't really want prices to go down any further.
And so all of these things in mind, what is the time span that you're monitoring for how this plays out to the point where it would materially impact not just this year's results, but also for companies that are operating and rely on some of these partnerships internationally for soybeans specifically, and other commodities perhaps, that would impact their ability for operations in the future as well?
Sure, that's a great question, Brad. And the first thing, the most important thing we're looking at is how quickly can some sort of an agreement be reached. And particularly important for us, the timeline we're looking for is when the crop would be harvested in the United States. Now, we haven't even planted it yet, so there's quite a bit of time. There's probably about 6 months. So we would hope that certainly there could be some sort of a new agreement in place by the 1st of October. And that's really the time when U.S. soy exports would start flowing in style to China. In the meantime, you know, China tends to import a lot of their soy at this time of year from South America because we have the two hemispheres that harvest the crops and they kind of switch back and forth. But what we'll also see, I think, is other countries, because U.S. prices have come down in reaction to this tariff talk, I think we'll perhaps see a little bit of an uptick in demand from other countries that will say, hey, U.S. soy's on sale, so they'll want to come and make some more purchases. So we're trying to find the best solution we can out of all of these sort of things.
Jim, lastly, while we have you, of course, consumers are watching this and saying, yeah, but what does this mean for the prices that I'm paying when I'm filling up the basket and my weekly or cyclical purchases, you know, as they're just trying to fill up the pantry or refrigerator?
Yeah, again, that's a good question. And we have to talk about two different sets of consumers. The last time that this happened, it was quite bad for Chinese consumers because the price they started paying for soy imports, which is a very important feed ingredient for their pork industry and their poultry industry, really went up because they weren't importing anything from the US. Likewise, for US consumers, those prices went down some. So if anything, it should help make US products here in the United States even more competitive. Now, I think our prices are already plenty low, so it's not feed ingredients. If there are prices that are high today, and I think everybody thinks of eggs being the high-priced item, it is certainly not the price of soybean meal or corn that is driving the high price of eggs. It is the shortage we have because of the avian influenza. But raw materials shouldn't be the problem. And if anything, with their low prices today, it should be helping U.S. consumers.
Jim Sutter, thanks so much for taking the time breaking this down with us.
Thank you, Brad. Appreciate it.